Okay, so it looks like we're diving into a whole stack of South African investment fund fact sheets today.
Yeah, looks like it.
Wow. Lots of numbers, charts, and
And a lot of jargon.
you got it. But hey, that's what we're here for, right?
Absolutely.
To decode all this stuff and figure out what it all means for you.
That's the plan.
So what's the mission?
I'd say our mission is to see if we can find those hidden gems.
Yes, those funds that might not be flashy, but actually deliver.
Exactly. The ones that are going to help you reach your investment goals.
All right, so let's jump right in. One thing that keeps popping up is this Regulation 28 thing.
Oh, yeah. That comes up a lot with South African funds, especially when you're talking about retirement.
Right, like the Satrix Stable Fund and the Sanlam Reg 28 Property Equity Fund both mention it. So what's the deal with Regulation 28? Is it like a big deal or just a box to tick?
It's a pretty big deal, actually, especially if you're investing for retirement.
Okay, so why? Why is it so important?
Well, it's all about risk management.
Risk management, okay.
Think of it as a safety net built into the Pension Funds Act.
Okay, a safety net.
It sets limits on how much risk you can take with your retirement savings.
Oh, I see. So it's like preventing you from going all in on some crazy investment.
Exactly. It stops you from putting all your eggs in one basket.
Makes sense. So what are those limits? Like what can't you do under Regulation 28?
Well, for example, you can't have more than 75% of your portfolio in equities.
75%, okay.
Listed property is capped at 25%, and offshore investments are limited to 45%.
Interesting. So does that mean Regulation 28 funds are all kind of like the same?
And not necessarily. There's still a lot of room for variation within those limits. Look at the Coronation Balance Plus Fund, for instance.
Oh, yeah. What about that one?
It's fully Regulation 28 compliant, but it still manages to pack in a whopping 74% equity exposure.
Wow, that's pretty high.
Right. That tells me the fund manager knows how to work the system, maximizing growth potential without breaking the rules.
So it's about finding those funds that are strategic about it.
Exactly. It's not just about blindly following the rules, but using them to your advantage.
That's a good point. So Regulation 28, it's not just a box to tick, it's something to really consider.
Definitely.
Now, I'm seeing some pretty impressive returns on some of these fact sheets.
Oh, yeah. Like what?
Well, take the SIM General Equity Fund, for example, boasting a 21.90% return in the past year.
That's pretty tempting.
Right. Easy to get drawn in by those big numbers.
No, it is. But remember, that's classic performance chasing. And that can be dangerous.
Oh, why is that?
Well, because past performance doesn't guarantee future results.
Oh, right. Of course.
It's like judging a book by its cover.
Yeah, you got to look deeper.
Exactly. Don't get blinded by those flashy short-term numbers.
So what should we be looking at instead?
Focus on the long term. How has the fund performed over 3 years, 5 years, 10 years?
Right, the long game.
And more importantly, what's the story behind those numbers?
The story? Okay.
For example, that SIM General Equity Fund we mentioned, with its impressive 21.90% one-year return, well, its 10-year average is actually lower than the Allen Gray Balanced Fund.
Oh, really?
Yeah, which has been chugging along steadily with a 10.8% average for the last decade.
So consistency matters.
Absolutely. Especially when you're talking about retirement planning, you need a fund that can weather the storms and deliver consistent returns over the long haul.
Okay, so consistency over flashiness. Got it. Now let's talk fees, because these fact sheets are a jungle of acronyms.
Oh, yeah. It's like a whole different language.
TRs, TCs, performance fees.
Yeah.
It's confusing.
Don't worry, we'll break it down for you.
Okay, thanks. So first up, T. What's that all about?
TR stands for total expense ratio.
Okay, total expense ratio.
Think of it like the annual membership fee for being in the fund.
A membership fee, okay.
It covers the cost of running the show, like paying the fund managers, administration, stuff like that.
So it's like the cost of doing business.
Exactly.
Okay, then there's TC, right?
Right. TC stands for transaction costs.
Transaction costs, okay.
These are like brokerage fees. You'd pay them when buying or selling individual assets within the fund.
So it depends on how much buying and selling the fund is doing.
Exactly. The more active the fund manager is, the higher the transaction costs will be.
Makes sense. And then there are those performance fees. What are those?
Ah, yes. Performance fees are like a bonus for the fund manager.
Bonus, interesting.
They get a cut of the profits if they exceed a certain performance target.
So if they do well, they get rewarded.
Precisely. It's supposed to incentivize them to outperform the market.
I can see how that works. But looking at these fact sheets, some funds have fees under 1%, while others are over 2%. Does that difference really matter?
It can, actually. It might not seem like much, but even a small difference in fees can compound over time.
Compound, you mean like interest?
Exactly. And that can significantly impact your final returns.
Okay, so fees matter, even if they seem small.
Absolutely. Every rand counts when it comes to investing. You want to make sure you're not giving away too much to fees.
Right. You want to keep as much of your money as possible working for you. Now, asset allocation, this is where things start to get really interesting.
Oh, yeah. This is where you start to see the real personality of each fund.
Right. We've got South African equities, bonds, offshore investments, property, even some things called alternatives.
It's like choosing ingredients for a recipe.
A recipe, that's a good analogy.
Right. Each ingredient brings its flavor and texture to the dish.
Exactly. So what are these alternatives we're seeing? Is that like investing in Bitcoin or something?
Not quite. Alternatives usually refer to things outside traditional stocks and bonds.
Okay, like what?
Think private equity, hedge funds, real estate,
Real estate, okay.
commodities, even infrastructure projects.
So it's like adding a little something different to the mix.
Yeah, the idea is that alternatives can potentially boost returns and reduce overall risk.
Reduce risk? How does that work?
Because alternatives tend to behave differently than traditional assets. They don't always move in the same direction as the stock market.
Oh, I see. So it's like hedging your bets.
Exactly.
Right.
Not putting all your eggs in one basket.
Makes sense. But wouldn't that make things more complicated to manage?
It can. That's why it's important to understand how those alternatives fit into the overall strategy.
Okay, so alternatives, they're not inherently risky, but you got to know what you're getting into.
Exactly. It's all about understanding the specific assets and the rationale behind them.
Okay, good to know. So we've got Regulation 28, performance chasing, fees, and asset allocation. That's a lot to digest already.
Yeah, we've covered a lot of ground, but I think we've laid a good foundation for understanding these South African investment funds.
I agree. And now that we have that foundation, let's move on to some specific fund highlights in our next segment. Stay tuned.
All right, let's get specific. All right, so ready to dig into some specific funds?
Let's do it. You know, you mentioned earlier that you're drawn to funds that align with your values. So let's start with that eco-conscious option, the Sanlam Living Planet Fund. Pretty intriguing, right?
Definitely. Partnering with WWF like that.
Yeah.
It's a pretty unique approach.
So WWF, they're like the ethical gatekeepers.
In a way, yes. They help ensure that the fund is investing in companies that are truly committed to sustainability.
Okay, so it's not just greenwashing.
Exactly. It's about finding those companies that are walking the walk, not just talking the talk.
So what kind of companies make the cut? Give us some examples.
Well, alongside familiar names like Microsoft and Google, you'll find companies like Vestas Wind Systems.
Vestas Wind Systems, okay.
They're a global leader in wind turbine technology.
Interesting.
And Ørsted, a renewable energy company focusing on offshore wind farms.
So it's a mix of established players and newer companies pushing the boundaries.
Exactly. There's also a good chunk allocated to sustainable agriculture and resource management. Companies developing innovative solutions in those areas.
It's like investing in the future.
Yeah, it's about supporting those who are creating a more sustainable world.
And what about returns? Does doing good have to come at the expense of doing well financially?
That's the big question, right? Well, the interesting thing is that the Sanlam Living Planet Fund's performance has been quite competitive.
Oh, really?
Yeah, it's held its own against similar non-ESG funds.
So you can do good and do well.
It seems that way.
That's encouraging. All right, let's move on to the Satrix Smooth Growth Fund. I know you're interested in a smoother ride, especially for your retirement portfolio.
Definitely. And this fund's approach is quite intriguing with those monthly bonuses.
Yeah, it sounds almost too good to be true.
It does. But remember, these bonuses aren't dividends, tied to company profits.
Right.
It's a different mechanism altogether.
So how does it actually work? How do they calculate those bonuses?
Well, it's a complex formula, but essentially it aims to smooth out the ups and downs of the market.
Okay, so it's like a shock absorber.
Yes, a buffer against those market dips. It considers the fund's expected long-term growth rate and adjusts the monthly payout accordingly.
So if the market takes a dip,
the bonus might be a bit lower that month.
And if the market surges,
the bonus could be higher.
I see. So it keeps things relatively stable.
Exactly. It's about minimizing those big swings that can make investors nervous.
I can see the appeal, especially as you get closer to retirement. Okay, let's switch gears to the SIM Active Income Fund. This one seems perfect for generating that regular income stream you're looking for.
Yeah, it's definitely geared towards income-focused investors.
So what are the key ingredients here? What are they investing in?
Well, it's a mix of South African assets that are designed to generate income. Things like bonds,
Lawns, okay.
money market instruments, preference shares, and even some listed property.
So a bit of everything.
Right, it's a well-diversified portfolio of income-generating assets.
And I remember you mentioned something about this one being tax-free, right?
Right.
You got it. It qualifies as a tax-free investment under Section 12T. No tax on dividends, interest, or capital gains.
Wow. That's a big plus, right?
Absolutely. Especially for retirees who are relying on that income. Every bit helps.
No taxes, consistent income.
Yeah.
Sounds pretty good to me. All right, next up we have the Diversified Balanced Fund. And what caught my eye is that 10% allocation to an emerging fund manager.
Right. That's a pretty unique approach. It's like blending the experience of established managers with the potential of a rising star.
A rising star.
Yeah. Emerging managers often bring fresh perspectives and a real drive to succeed.
So it's a bit of a gamble.
There's always some risk involved, but it's a calculated one.
Okay, so how does this fund mitigate that risk?
Well, the majority of the portfolio is still invested in funds managed by established firms.
Oh, I see. So it's like a safety net.
Exactly. It provides that stability and track record while still giving that emerging manager a chance to shine.
It's like having the best of both worlds. Now, we also have some funds of funds in this mix, like the SIM-managed conservative fund of funds. Can you remind us what those are all about?
Ah, yes. Funds of funds. Imagine you're at a fancy restaurant,
Okay, I'm listening.
and instead of ordering a la carte, you choose the chef's tasting menu.
Oh, I see where you're going with this.
Right. You're letting the chef curate the perfect meal for you.
So with the fund of funds, you're essentially letting the fund manager choose the best underlying funds for you.
Precisely. They do the research, the selection, and the ongoing monitoring.
So it's like having a personal investment chef. Sounds pretty convenient.
It is. It's a great option for people who want a diversified portfolio, but don't have the time or expertise to manage it themselves.
Right, it takes the guesswork out of it. But are there any downsides to this approach?
Well, one potential downside is the cost. Funds of funds typically have higher fees than single strategy funds.
Because you're paying for that extra layer of management.
Exactly. You're essentially paying fees on top of fees.
Okay, so that's something to consider.
Definitely. You have to weigh the convenience and diversification against the potential for higher costs.
Now, I've noticed that a few familiar names keep popping up in the top holdings of many of these funds. Naspers, First Rand, Standard Bank. Are those like the South African blue chips?
You could say that. They are some of the biggest and most well-established companies on the JSE.
Okay, so they're like the anchors of the South African market.
Exactly. They provide a sense of stability and have a long history of performance.
It makes sense why they would be in so many portfolios. Now, speaking of portfolios, I'm noticing a lot of global exposure in these funds, especially with equities. Is that a common trend these days?
It is. South African investors are increasingly looking to diversify beyond the local market.
And why is that?
Several reasons. One is Regulation 28, which allows up to 45% allocation to offshore assets.
Okay, so it's allowed.
Yeah, but also investors are seeking growth opportunities in other parts of the world.
I see. And maybe a hedge against any South Africa-specific risks?
Exactly. It's about not putting all your eggs in one basket, both geographically and in terms of asset classes.
So diversification is key. But when you're investing globally, you have to deal with currency risk, right?
Absolutely. That's a crucial consideration.
And I'm seeing both hedged and unhedged approaches in these funds. Can you explain the difference?
Sure. So currency hedging is like taking out insurance against those currency fluctuations.
Insurance, okay.
Let's say you invest in a US dollar denominated fund and the rand weakens against the dollar. That's good for you.
Yeah, for you. How so?
Your returns will be higher when you convert those dollars back to rand.
I see.
But if the rand strengthens, your returns will be lower.
Okay, so it's a double-edged sword.
Right. Hedging can protect you from losses, but also limit your gains.
So how do you decide whether to hedge or not?
Well, it depends on a few factors, like your risk tolerance, your investment goals, and your view on the future direction of the rand.
Okay, so it's not a one-size-fits-all approach.
Exactly. Some funds hedge a portion of their foreign exposure, while others don't hedge at all.
It's interesting to see those different approaches. Okay, let's move on to performance data. I'm looking at all these numbers. Annualized returns, cumulative performance, those highest and lowest annual returns figures. It's a lot to take in.
It can be overwhelming, but remember the key is to look beyond the numbers and understand the story they tell.
The story, okay. So where do we start?
Well, first, remember that past performance doesn't guarantee future results.
Right, we talked about that. It's like looking in the rearview mirror.
Exactly. It tells you where you've been, but not necessarily where you're going.
Okay, but it can still give us some clues, right?
Absolutely. It can help you understand the fund's track record and its overall risk profile.
Okay, so let's break down these different measures of performance. What are annualized returns?
Annualized returns are basically the average annual rate of return over a specific period.
So it smooths out the ups and downs.
Exactly. It gives you a more consistent picture of the fund's performance.
Okay, that makes sense. Now, what about cumulative performance?
Cumulative performance shows the total growth of an investment over a specific period.
So it's like the big picture.
Exactly. It tells you how much your investment has grown overall.
Okay, and finally, those highest and lowest annual returns figures. What do those tell us?
Those are important because they give you a sense of the fund's potential range of outcomes.
Both good and bad.
Yes. It's a reminder that investing always involves some level of risk.
A reality check.
Exactly. Even the best performing funds can experience periods of significant volatility.
Okay, so don't freak out if you see some big swings in those numbers.
Exactly. It's all part of the game.
No, I'm seeing these risk profile labels on the fact sheets: conservative, moderate, aggressive. Are those helpful or just marketing hype?
I think they can be helpful as a starting point. They give you a quick snapshot of the fund's overall risk level.
Okay, like a spice level at a restaurant.
Exactly. Conservative is mild, aggressive is extra hot.
So choose your spice level based on your own risk tolerance.
Exactly. But remember, those labels are subjective and
Yeah.
can vary between fund managers.
Right, always best to look under the hood and see what's really going on.
Agreed.
So we talked about borrowing, script lending, minimum investment requirements.
Yeah.
Are there any other red flags or green lights investors should watch out for?
Well, one of the most important things to consider is the fund manager's experience and track record.
Okay, so like checking their resume.
Exactly.
Yeah.
How long have they been managing money? What's their investment philosophy? How has the fund performed under their leadership?
It's like choosing a surgeon. You want someone with experience and a good track record.
Exactly. You're entrusting them with your financial well-being, so it's important to do your research.
Makes sense. Any other tips?
Don't forget about fees. Even small differences in fees can add up over time. Always compare expense ratios and factor those costs into your decision.
Right. Those fees can really eat into your returns if you're not careful. Okay, I think we've covered a lot of ground here, from broad concepts to more specific fund features.
We have.
Any final words of wisdom for our listeners as they embark on their investment journey?
Remember, investing is a marathon, not a sprint. Stay focused on the long term, don't try to time the market, and choose funds that align with your own goals and risk tolerance.
Excellent advice.
Yeah.
So, with that in mind, let's wrap up this segment and move on to our final thoughts in the next one. Stay tuned.
Sounds good.
All right. Time to put all this knowledge to work. Let's dive into some of those specific funds you've got in your stack of fact sheets.
Yeah, let's get down to business.
You mentioned wanting a smoother ride, especially for retirement, right?
Definitely. Stability is key.
So the Satrix Stable Fund might be a good place to start.
Yeah, it looks promising.
What are you seeing there?
Well, first off, their asset allocation is really balanced. You've got a mix of equities, bonds, cash, both local and international.
So it's like a well-rounded portfolio.
Yeah, it's designed for stability and resilience, not about chasing the highest returns,
Right.
but about weathering those market storms.
And what about the fees? Are they reasonable?
Oh yeah, very reasonable. Total investment cost is just 0.30% per year.
That's pretty low.
It is. You're not losing a big chunk of your returns to fees.
So low fees, a smooth ride. Sounds good to me. What about the Sanlam Wealth Builder?
Ah, yes. This one is a bit more growth-oriented.
Okay, so higher risk.
Potentially, yes. They're tilting more towards equities,
I see.
but still with diversification across local and global markets.
Uh-huh.
They've also got some listed property, direct property, credit.
So spreading the risk around.
Exactly. Aiming for higher returns, but not putting all their eggs in one basket.
What about the fees on this one?
A bit higher than the Satrix Stable Fund, 0.79% per year.
Okay. Still not outrageous, though.
No, not at all.
Hmm.
But it's something to consider.
Yeah, the question is whether the potential for higher returns justifies those extra fees.
Exactly. That's the trade-off. Investors need to weigh that carefully.
Okay, on to the SIM General Equity Fund. This one's all about South African equities, right?
That's right. If you're bullish on the JSE, this could be a good option.
Bullish, meaning?
Meaning you believe the South African market is going to go up over the long term.
Gotcha. So this fund is for the optimists.
You could say that it's a high-conviction approach, but it comes with higher risk, too.
Well, yeah, equities are generally riskier than bonds.
Exactly. And this fund really illustrates that.
Oh, so?
Just look at those highest and lowest annual return figures.
Yeah, those are pretty wild.
A 35.90% gain one year and an 11.11% loss the next.
Ouch.
It's a roller coaster ride. Definitely not for the faint of heart.
So this one's for investors who can stomach those big swings.
Absolutely. You got to have a strong stomach and a long-term perspective.
Okay, let's move on to something a little more calming. The SIM Active Income Fund. This one seems perfect for those seeking a steady stream of income.
Yes, it's a great option for income-focused investors.
So remind us what kinds of assets they're focusing on.
Mostly South African assets that generate regular income. Bonds are a big part of it.
Bonds, okay.
Money market instruments, preference shares, some listed property, too.
So it's designed to pay out regular income while preserving capital.
That's the goal. And there's another big advantage to this fund.
Oh, yeah. What's that?
It's tax-free.
Tax-free. That's fantastic, especially for retirees.
Exactly. No tax on dividends, interest, capital gains. It's a huge benefit.
Okay, and lastly, we had the Diversified Balanced Fund with that interesting 10% allocation to an emerging fund manager. What do you make of that?
I like it. It's a creative way to add some potential spice to a balanced portfolio.
Precise.
You know, that possibility of outsized returns.
Right, but without taking on too much risk.
Exactly, because the majority of the portfolio is still with those established managers.
So it's like a little bit of adventure, but with a safety net.
Precisely. You get that seasoned experience alongside the potential of a rising star.
I like that. All right, we've covered a lot of ground today, from those broad principles to some specific fund highlights. What are your final thoughts for our listeners as they navigate these choices?
Well, I think the key takeaway is that there's no one-size-fits-all answer when it comes to investing.
Right, everyone's different.
Exactly. The best fund for you depends on your individual goals, risk tolerance, time horizon.
And even your values, right.
Absolutely. So do your research, understand the different options, and don't be afraid to seek professional advice.
Good advice.
But most importantly, trust your gut. Make informed decisions and, enjoy the journey.
Absolutely. Investing's about building a future you're excited about. And on that note, we'll wrap up this deep dive into South African investment funds. We hope you found it helpful.
Thanks for joining us.
And happy investing.